Gold clearly protects purchasing power in inflation. I think when I was last on your show, I said that it wasn't necessarily the best inflation hedge. And, I stand by that. There are many things, if you look historically at different inflationary periods, there are other things that have outperformed gold.
What should we do now to protect yourself against rising inflation? That's the core of our discussion today. I like to just start by showing you a few charts. The first one being this one that I put together. This is the red line shows the CPI index. The orange, the yellow line rather, shows the GLD ETF, so it's a proxy for gold prices. And the blue line shows the S&P 500 ETF, the SPDR. Now, I've rebased all three series to the start of 2004. I wish I had more data for this exercise, but 2004 was all I had. Now, from 2004 to the present day, the CPI increased by 47%. The S&P 500 grew by 5.2 times, so it's up to 521 on that index, rebased to 100. And the GLD ETF grew by 3.8 times, so it's at 383. So both these asset classes beat inflation by a wide margin. However, stocks still won. Okay, I'll leave you to comment on that. Of course, the time frame matters. I'm aware of that. I know that's what you're going to say. Again, I only had data back to 2004. Adrian, what is the best inflation hedge, in your opinion, keeping in mind the chart that I just showed?
Yeah, gold clearly protects purchasing power in inflation. I think when I was last on your show, I said that it wasn't necessarily the best inflation hedge. And, I stand by that. There are many things, if you look historically at different inflationary periods, there are other things that have outperformed gold. And frankly, as they should, because gold is meant to be a hedge. It's meant to be a insurance policy. So we shouldn't expect it to be the best performing asset, frankly. Something's really wrong if it is. But typically, other commodities have done better. Oil in particular, has done better. Real estate can do better. Certain types of stocks can do better. Now, if you look back at inflationary periods, it's not the table of, but ranking of 1, 2, 3, 4 are not always the same. A lot depends on other factors. If you have an Arab oil embargo in 1974, well, guess what? Oil does well. If you have a Ukraine, flare up, guess what? Oil does well. When we talk about the stock market, if you have a modest inflation, a relatively modest inflation with a strong economy, well, stocks will do very well. If you have a stagflation, stocks will not do so well, as we saw in the 1970s when they lost money. If you have a hyperinflation and currency controls, and everybody pours their money into stocks. So Zimbabwe was the best performing stock market in the world for many, many years. And Argentina and Venezuela, the Venezuela stock market, I've got some numbers here. Let me just give you. The index has gone in the last 2 years from 88 to 6,600, the index of Venezuelan stocks. Now, at the same time, the Bolivar has gone from 46 to the dollar to 4.1 million to the dollar. So you haven't actually made any money in real terms. What I'm saying is there's a lot of other factors. I'm not going to criticize you for starting for 2004 because you've got to start somewhere. But there's always other factors that go into any of these things. Well, I would let me just say, I think gold is probably the surest hedge against inflation. But other things may well be better.
Like this chart shows, stocks did actually really poorly relative to inflation in the first half of the 2000s. It wasn't until later on that it caught up and it exploded last year, hence the outperformance. But Lobo, I'd like to get your take. So how would you respond to Adrian's comments?
Well, first, I would say if you go to this wonderful website called kitco.com and you pull up the live gold chart, there's a little box to the side that shows the performance over the last 30 days, 6 months, year, 5 years, and 20 years, or 22 now. If you go to the since 2000 number, it's up 560%. So I think that actually, given that starting point, gold would have outperformed the S&P 500. So yeah. Your timing does matter here, but let's not pick nits. There are several answers I would have. What is best? what does that even mean? Does it mean highest return or highest return for risk?
Right.
And how does liquidity fit into that? It might be that owning my house free and clear with no lien whatsoever on it in a low tax jurisdiction would be the best hedge of all. There's basically no risk there. It's mine. Nothing's going to happen to it. But it's not very liquid. If I run out of cash and I need to feed my family, I can't just sort of sell the east wing or the portico on the south part, and come home with a truck full of bread to feed my family with that. Obviously stocks are very liquid, but if you're buying them as an inflation hedge, but things get chaotic then and there's a stock market crash, you could be looking at a serious loss of capital at the time that you're in need of funds. I'd say the same thing for Bitcoin too, by the way. An asset that can lose 50% in a few months, that's not a safe place to hedge against inflation, even if, in some future Bitcoin becomes the one ring to rule them all and so on, fine. That doesn't help me if I need liquidity at a time when it's way down.
Well,
so
Adrian,
gold, sure. I'll finish with gold here.
Yeah.
Gold can certainly go down and up and down, but it doesn't fall off cliffs like that. Not very often, not for long.
True.
So in terms of a balance between liquidity and protection against inflation, I am partial to the monetary metals.
Okay, right. Okay. All right. Let me show you another chart. Lobo, I've shown you this chart before, and I'd like to get Adrian's comments as well. Lobo, I'm not doing this just to annoy you. We talked about this chart several times, but I have to update the data because every time we have you on, the data changes. Again, I'm not saying that gold is not a good inflation hedge, but you're both pro-gold, so I have to play devil's advocate. Otherwise, it'll be a boring conversation. But take a look at this chart. Headline inflation versus gold. You've got blue line representing the inflation rate, so the CPI on an annual percentage change basis. And I've got the orange line as the GLD ETF also on an annual percentage change basis, so we're comparing apples to apples here. The blue line has continued to go up while inflation, has skyrocketed, while the orange line, the rate of change has peaked around March 2020 and has since gone down, as you know. So inflation has outpaced gold, at least for the last year. What is the cause of this, and can this continue? Lobo, I'll start with you.
Sure. Well, you know my answer, but we'll go ahead and give it for anybody who hasn't heard it yet here on the show. Gold tends to lead inflation, and I think your chart actually shows that beautifully. We had this big spike up. Gold was already rising before the COVID-19 situation happened, and then when that did break out and people could see the writing on the wall, oh my gosh, look at all this free money flooding out from the Fed and from Congress. Gold went nuts. That's exactly what you would expect from an inflation hedge. So it leads, and then, reality sets in, the programs start winding down, there's a period of consolidation. It's really interesting to me that gold has in fact not tanked. And people were worried that spike in 2020 would be like 2011, 12 all over again. That hasn't happened. We held at a record high price for more than a year now at gold. And not to take the thunder too much away from Adrian here, but that bullish upturn at the end of the chart, I find quite encouraging, because if gold leads and it predicted the inflation we've already had, and everybody was drinking the transitory Kool-Aid, it made sense for gold to cool off after that rally. Everybody's believing that Fed's got the tools, it's under control, it's transitory, it's base effects, and then no, it's Delta, and then no, it's Omicron, no, it's supply chains. All these transitory reasons would say that, well, it's going to go down, therefore we don't need gold anymore. Mm-hmm. But to see gold coming back up again says that people are starting to get the idea that maybe that transitory yarn wasn't true. Yeah. And so if gold's leading again, that actually calls for high inflation, sustained over years ahead.
Well, Adrian, how would you read this chart? Because if gold were to spike up and become, act as a leading indicator, like Lobo said, wouldn't you expect it to remain elevated, at least in the face of rising inflation? Keep in mind that inflation continued to go up while gold peaked and came back down. Wouldn't you expect it to stay around $2,000?
Yeah, no, not really. I think a couple of things, and I agree with most of what Lobo said. I think people always expect too much from gold. That's one thing I'll say. I've never met a gold investor that says, wow, did you see gold is up today? It's a great price. They always expect too much. And I also, so to me, there's three main factors looking at, and it's a slightly different take from what Lobo said. But, first of all, we had that spike from March to beginning of August to 2020 was a really exaggerated spike. What was it? Gold was up 40%. Yes. I mean, an insurance asset is not supposed to go up 40% in 4 months. So it was an extraordinary and exaggerated move. And gold stocks, which more than doubled in those 4 months, were overbought, certainly, if not overvalued, but certainly overbought. And I think we simply had, to a large extent, what we saw for the next 16 months was simply a very long consolidation. And if you look back at 2008 or look back at 1975, look back at other times when gold had sharp spikes and then had a retracement, the retracements were far deeper than what we saw from August of 2020 to February of this year. And Lobo is absolutely right in that the interesting thing is that gold didn't go down more, frankly. There was very strong buying support for gold every time it did. So that's the first thing. The second thing I'd say is that you had a situation where other assets were doing well. Stocks were doing well, real estate was doing well, and people don't feel the need for a hedge when other assets are doing well. The third thing I'd say, and Lobo touched on it, you had gold spike like that at the beginning of 2020 because of COVID and the lockdowns and everything else, and then it started pulling back. You had a lot of new buyers that come in, who tend to be weak hands. But then you had the Federal Reserve in the last, the second half of last year, you had the Federal Reserve start threatening to raise rates. And we all know, we've seen it, the charts are very, very clear. But 6 months ahead of tightening, gold goes down because the market is afraid of higher interest rates, tightening, and they believe the Fed. And conversely, the dollar tends to go up 6 months ahead of action. But once the Fed acts, gold tends to reverse and move up. You saw it in 2015. You saw it in 2013. Gold bottomed on the exact day that the Fed started tapering. And it's not a coincidence, because when the Fed starts to implement what they've threatened, we suddenly realize that this emperor doesn't have an awful lot of clothes. So it's a lot of talk and not a lot of action. So we'll see what happens. I mean, now they're talking, someone just yesterday was talking about 10 interest rate hikes this year. That just isn't going to happen. They don't have enough meetings scheduled to raise 10 times.
They could do it intermeeting, I guess. They'll have to do it intermeeting, I guess.
Yes, it's not going to happen. And so the market hears all this stuff, gets concerned, but once they start implementing it, they realize that, it's not going to happen. And let's not forget this. Mm-hmm. Even in the worst or the most extreme case of balance sheet reduction, and in the most extreme case of interest rate hikes that any Fed official has talked about, at the end of 12 months, we will still have a balance sheet that is twice as big as it was last year, and we will still have negative interest rates, deeper negative than in 1976 at the beginning of that huge gold move in the 70s. So, tightening this ain't.
Is it the level of the real interest rate that matters most for gold, or the direction of the real interest rate that changes the gold price?
You want to answer that, Lobo? I mean, it's the direction. The direction is important, obviously. But again, if you're constantly behind the 8 ball, then that's a different situation. So you can have interest rates moving up, as we saw in 2004-5. You can have interest rates moving up multiple times, but constantly behind the 8 ball. And that's positive for gold. The only thing that's negative for gold is Paul Volcker coming in and jacking up Treasury bills or Fed funds rate to over 20%. And,
they're not going to do that this year.
To paraphrase Lloyd Benson's famous attack on Dan Quayle, I knew Paul Volcker and Jerome Powell, ain't no Paul Volcker.